Hey, everybody, and welcome back to the Teaching Tax Flow podcast, episode 120 today. The question at hand is, should I be or should I not be an S-Corp? That is the question. So today we're going to talk about it. We're going to see when you should elect to file as an S-Corp. But before we do that, let's take a brief moment and thank our episode sponsor.
Are you leaving money on the table? Are you an accredited investor seeking new and exciting investment opportunities? Look no further than Integrated Investment Group, your trusted partner in financial success. At IIG, the focus is on delivering exclusive investment options tailored to your unique needs and goals. Contact them today and let their expert team guide you toward your financial aspirations. Wondering if you qualify as an accredited investor? Visit teachingtaxflow.com/IIG to find out and take the first step towards a brighter financial future. Integrated Investment Group. Your path to financial success begins here. Securities offered through Cabin Securities. Member FINRA SIPC.
All right, everybody, we are back here again on the TTF, the Teaching Tax Flow podcast. And obviously in the intro, we said it, we are going to dive into when you should elect to be an S-Corp. So what does that mean? I'm sure if you're in certain business activities, you may have heard that being an S-Corp is the best thing you could possibly do, but you could be wrong or you could be right. So we're going to dive into this. Obviously, I brought my better looking, smarter co-host, Chris Picciurro, to the party. Chris, what's happening, man? How are you?
I'm great. How are you doing?
I'm doing good. I know this is a topic, again, we say that all the time because we plan these out and we base the content off what people are asking. But this, again, really is something we hear a lot. And, myself not being in the tax world, like you are and some of our colleagues are, it's almost confusing to me at times because some people get so jazzed up, they get so excited about it. And then it's like, it's probably not the best idea. So I look forward to having this discussion. And, maybe, Chris, we start off with, what exactly is an S-Corp? Is this something you check the box?
Well, we did do a previous episode on S-Corp basics. So I think that was episode 45, somewhere in there. And that's where we really walk through what an S-Corp is. But in our private practice, I talk to people we're working with all the time, that ideas are cheap and implementation is valuable. So I'm going to explain what an S-Corp is, but we have an entire episode on the nuts and bolts of what an S-Corp is. Today, we're going to focus on when you should actually apply this concept to your situation and when it's probably not a great idea to apply it. We always recommend you work with your tax professional and talk through the long-term ramifications of any type of decision. To answer your question, an S-Corporation is kind of a hybrid type of tax entity. And what it is that if you have an LLC or a C corporation, it is an election you make to be taxed in a certain way. When an S corp, what an S corp does is that it has some of the characteristics of a corporation or a C corporation, but it has the flow through of an LLC, meaning the S corp itself on a federal level is not taxed. The owners of the S-Corp or the shareholders of the S-Corp are taxed on their personal return based on the profit and loss of the S-Corporation. The main advantage of the S-Corp, the 99% advantage is that in the right situation, S-Corp earnings, here's the main advantage. S-Corp earnings or net income from an S-Corp are not subject to self-employment tax or that 15.3, which is Social Security and Medicare tax. That's the advantage of the S-Corp. However, many people that aren't paying that tax for some reason decide to be an S-Corp, but that's the main benefit of it. Now, there are some things you need to know about making an S-Corp election, and if you are a business owner and you're working in the company, you have to pay yourself what's called a reasonable compensation. We're going to talk about that in a couple of minutes. And then after you pay yourself the reasonable compensation, the remaining profit is exempt from the Social Security and Medicare tax. That's the main advantage of an S-Corp. So that's one of those things that that a lot of people, you want to. I always think about a fish tank, right? And And you don't want to put freshwater fish in a saltwater fish tank and vice versa. You have to make sure that you have the right tank for the right fish. So, depending on your business, so we're going to talk through when should you consider to elect to be an S corp. Now, I will say one more thing, and then we're not going to talk about the tax compliance too much on the S corp. Is that you have until March 15th of any year, in general, give or take, depending on leap year, holidays, weekend, to elect S corp for that year. So if it's February 10th, and let's say you have a single member LLC and you decide you want to be an S corp and it's February 10th of 2025, you can make that S corp election and make it retroactive back to January 1st of 2025. There are some issues with if you elect late. I mean, there's a ton of I'm just going to say it is a very messy process, as far as the S corporation elections. Now, the form you file, a Form 2553, is easy to file typically. But as far as the IRS obtaining that form, and I can't tell you, it's weekly where someone says, "Oh, I'm an S corp," and the IRS never got the form. Well, I thought my attorney filed it out. Oh, I thought I mailed that in. Oh, I e-filed it. You can't e-file it. So again, there's it is kind of a very frustrating situation for many accountants. However, let's talk about when it makes sense and when it doesn't make sense. And
Sure. So a couple things on that too, Chris. Just kind of what I'm taking from this are a few things, right? So to when you're electing to file as an S corp, it's not, like I said, that I think I use the analogy or the situation of it's not a box you check on, when you're starting your business. It's not something that kind of is behind the scenes. You're never checking the S corp box on a W-9 or anything like that. It's just the election you're making behind the scenes, if you will. Is that right?
correct. You obtain a federal identification number, you file your articles of organization or incorporation with your state, and then you make the S election. If you are a C corporation, though, you need to be extremely careful about making an S corp election, because of something called the big tax. That stands for built-in gain. So that goes far beyond the scope of this episode. That's why you need to work with a tax professional. So we're going to jump in and when it does make sense to be an S corp. So an LLC or a C corp can elect to be taxed as an S corp. And so when should you do it, right? Well, remember, the advantage of the S corp is that you mitigate your self-employment tax, or you mitigate double taxation when you're talking about a C corp. If you're scratching your head thinking double taxation, don't worry. Jump on a Teaching Tax Flows YouTube channel. We have we have content on every type of business entity. So an S corp could make sense, one, if your business is profitable, right? Because to mitigate tax, that means you have to be paying tax. I can't tell you how many times people have elected S corp before their business is even profitable. That makes no sense to me, but that's all right. That's why you had to drag me kicking and screaming to do this episode, because it really it's very frustrating, to be quite honest. Not just myself, as you know, and many people, listeners know, I am very fortunate to work for the National Association of Tax Professionals doing year-end tax season update. So I taught, I think, 300 or 400 other tax professionals over the fall and winter. And trust me, I'm not the only one that shakes my head and gets frustrated about the whole S corp process and people electing it when they shouldn't. So anyway,
And
your
actually,
business has
so
to be
Chris,
profitable for it to make sense. If your business isn't profitable, an S corp election is not a good idea.
right, that's a terrible idea. Don't get excited about it. It's not like, oh, yay, make a sign or a billboard that you're now an S corp. So how many times? I mean, not the exact number probably, but you've been doing this a while. So you've been a tax pro for how many
A long time.
centuries now? Two or three? Was it like when the Romans were around? Doing the
Yeah,
um,
yeah. Actually, we had an abacus.
you
Didn't have a
you know what it
calculator.
was? You're not that old, but I'm sure you and Abe Lincoln sat down together, had a discussion about anyways, I'll be nice. Chris just had a birthday not too long ago, if anybody's wondering why I'm giving him a hard time. I won't say the number, but it's up
Hey,
there.
that's all
Close enough
right.
to it.
I'm excited that I made it to 50. So I'm
That
not I'm good with it.
it's a
But yeah,
milestone. But so actually what I was gonna ask you before I started razzing on you. So do I'm sure you've seen it a lot, but then also say somebody comes to you. You get a new client or, a client you guys have been working with for a while. They're all excited. They've elected to be an S. And is it a messy situation if you sit down, you said, that was a terrible idea. Let's revert back to how you were before. So if somebody did it, is it kind of not a death wish, but what does that look like?
It just depends on the situation. The problem is if you revoke an S corp, then you go back to being a C corp. So yeah,
Okay.
the thing
Mhm.
is, consult your tax professional before you make this S selection. If your business is profitable, it might make sense, maybe. But if it's not profitable, it doesn't make sense. The second thing is you have to be able to justify a reasonable salary to yourself. We, in our private practice, run reasonable compensation reports for our clients to determine what is a good salary. So let me give you an example, John. Let's say you were uh, owned a cleaning company, right? And your net profit was $200,000. Good for you. You're paying, and you're self-employed or you're a single member LLC. You're paying tax on the entire 200 grand, plus you're paying self-employment tax on about $180,000 of that, up to your Social Security max. Well, you would probably be a good candidate for an S corp. The next step would be is, all right, well, let's look at a reasonable compensation for someone that is running that cleaning business. And that might come out to, $60,000. And in that case, you would pay yourself a $60,000 salary on a W-2, and you'd mitigate some of the payroll taxes on the additional $140,000 of profit. Remember, you've got to be profitable, right? But you also have to be able to justify a reasonable salary. And so that's where the IRS doesn't come out with a salary chart. It has to be quote unquote reasonable. So we look at what your role is in the business, what the industry standards are, and your skills and expertise, and pay yourself that reasonable salary. Reasonable salary is not zero. If you're working in the business, you have to take some type of reasonable salary. So
So where it probably doesn't make sense, just throw a little simple situation out there. Say you're 75,000 in the black and your reasonable comp is 70 or 75,000. There's no there's no point in doing it with that, right? So I think a lot of people would fall into that unless, your best way to put it maybe is, and this is me feeling smart, is if you're profitable well beyond what your reasonable comp is, right? So
then it can make a lot of sense. Correct.
awesome.
Correct.
Awesome.
That would make so then what other reasons, right? Let's say you operate in a tax-friendly state. Now, you've got to be careful. I live in the state of Tennessee. It's very much considered tax-friendly. However, we do have a franchise and excise tax. States like California have a franchise tax as well. So when you elect S corp, you got to make sure that you're not triggering some type of state or local tax. Now, this podcast we focus on the federal tax, but it is a consideration. So if you operate in a tax-friendly state, then an S corp might make sense. And the other thing is, if you want to, like I said, pass through, you don't want to be subject to double taxation. So if you want to pass through your tax for the business onto your personal return, um, or if you potentially want the opportunity to have your entity pay for your state tax and get a deduction for it, because right now under the Tax Cuts and Jobs Act, your state and local income tax deduction is capped at $10,000. So if you're listening to this, let's not get in the weeds too much. If you're paying a significant amount of state tax and you're self-employed or a partnership, you might want to consider S corp, and then, especially if you're self-employed, and then make a what's called PTET, which stands for pass-through entity tax election. So that's what I'm looking for. Is ultimately, the S corp makes sense if you can pay yourself justify a reasonable salary and pay yourself that, and if it makes sense tax-wise, if there's enough tax savings or tax mitigation to justify the effort. In general, remember, if you elect an S corp, you've got to pay yourself salaries. You've got W-2 wages. You have a 1120S, which is a separate tax return. So in general, the compliance for an S corp is going to run, as far as tax prep and payroll processing, is going to run at a minimum of $2,000 a year. On average, probably about $4,000 to $5,000 a year. So there's a cost to it. But if you're going to save $30,000 in tax, okay, now it might make sense.
Right. No, it's awesome to break it down like that. And I think it's really what we're getting into. I kind of see a little bit of a trend. It's, we're talking more about when it's not appropriate, really, than when it is. So I'm going to make the assumption that majority of the people that you come across, you're kind of like, probably not the best idea for you to do that. And then, really in your private practice over the years, I mean, what industry do you think, like the makeup of the type of individual in business,
Oh,
have
well,
you seen
yes.
it the majority of the time, them
When does it make right? Because
not
like you
making the
said,
best?
let's say you have a medical doctor and they're self-employed, right? And they make $200,000 a year. I can't justify paying a medical doctor that is 100% uh, in their practice much less than $150,000 a year, maybe 170. We'd have to run the report, right? We'd have to do the work. For that, there's not much arbitrage. So when does it make sense? When you have a highly profitable business and the salary that you can pay yourself that's reasonable is low or lower, right? So my cleaning business example, um, it just depends. It's all factually dependent, right? So yes, so I would say more of the like let's just for lack of a better term, maybe more of the blue collar businesses that we could justify a reasonable compensation for the owner and operator of less than $100,000. Or let's say someone's not spending 100% of their time in the business, right? So let's say you are a medical doctor, you open up a practice, right? And let's say you have a couple other doctors working there and you're self-employed and you're making $300,000 net and you should be paying yourself $200,000 on a W-2, but you only spend 1 day a week there. Maybe you're partially retired, right? Then your reasonable comp's only 20% of what you should be paying yourself in salary. So then it would make sense. So, yep. So when should you not be an S-Corp? Because
This
this
is
one,
exactly what I was gonna ask you. It's like,
yeah.
what's the not? It's like I feel like we're right on the edge. It's like, what are the ones that, it's like, dude,
Okay.
don't do it. Don't jump off the cliff. So
Yeah. If you're currently a C corp and you have highly appreciated assets, or you would be subject to that big tax. If your business is not profitable, there's no reason to be an S corp. If you operate, if your business owns a lot of real estate. Now, if you're flipping properties, that's one thing. But if you have any type of buy and hold properties, an S corp is 99.99999% of the time a horrific idea. I usually don't get that vulgar on this
we need to make
podcast.
like a meme or something of you saying that. It's just like your arms up, being like, horrific. Don't do it.
It's
Don't do it.
horrific. I'm gonna be nice. Why? Because you don't get a step up in basis on the sale of the property. You also you don't the losses from an S corp don't flow to your personal return on rental properties like they would uh, if you were a partnership or you owned it personally. And if you take the property out of the S corp, you've got a deemed sale. I'll give you a real example of someone that we worked with last year. They came to us for a personalized tax plan within teaching tax flow. The person bought a truck for like 80 grand, depreciated the entire thing year one, of course, then proceeded to sell their business, right? The business got sold um, and still owed money on the truck. And part of the buy and sell agreement was the buying company said, well, you've got to, um, you've got to get that truck out of the business. Does that make sense?
Mhm.
Truck's still worth 50 grand, right? Once he deeded the truck out of the business, that's a deemed sale. He picked up, and guess what? He depreciated the entire truck year one. He just had a $50,000 taxable event from moving that truck from his S corp to his personal name. How much cash did he get? Nothing. So again, when you have appreciated assets, you don't want them that could come out of the business. You don't really want to be an S corp.
Mm. And when
Um,
you move property out of a business like that, like say it's sold, say you have, we'll just call it $100,000, you depreciate it all in the first year. Say after a year, it's still worth 80.
mhm.
And I mean, how does that work with like depreciation recapture at that point too? Is that
Yeah, if you take it out of the S corp, it's a deemed sale. So you're going to pay
it's
tax
all
on the
yours?
depreciation recapture. Yeah.
Oof,
Yep.
oof. That's a
If
punch
you
in the gut.
so it is. So that's where, that's one of those things. Um So yeah, I mean, if you have a high state tax on S corps, obviously it might not make sense. If you have a complex ownership structure, probably an LLC or limited partnership is going to make sense because with an S corp you can only have one class of stock, and you can only you can only allocate profit and loss and distributions based on the ownership percentage.
Right.
So
Makes sense.
there, the bottom line is, unless it's a slam dunk, unless you're going to find a ton of value in tax mitigation on the payroll taxes, and that far exceeds your costs associated with the S corp, um, then it's probably best to not be an S corp. When you have complex ownership structure, when you have 8, 9, 10 different owners, it just, the S corp just starts to not make sense.
Right.
And there's
And
a
I know
bunch.
this was actually a piece that came up too. We did a kind of on-demand session on tax savings for businesses making over 150,000, and S corps came up in that. We got a couple more coming up, so we'll be sure to put that link too in the show notes if anybody's interested on either watching a previous one or hopping on one of the future ones too. You'll hear it come up.
Exactly. Hey, I'm an advocate of S corps in the right situation. They could definitely work. However, probably 60 to 70% of the time, I feel it's misused. So if you have a question though, and you're not sure if S corp makes sense for you, jump into the Defeating Taxes private Facebook group. We're going to be there to help guide you. Don't be afraid of them. Just don't jump into them. If you formed an S corp, and you think maybe I shouldn't have done that, before you revoke the election, talk to a tax professional and see what your best option is to remedy that. And I can't tell you how many times I've run into it where someone thought they were an S corp, filed as an S corp, and the IRS never got the documents. They don't have evidence. They sent them to the form to the IRS, and ultimately they get a tax return rejected. And now you got a mess because just a very messy situation. So,
As you can tell by
it's kind
Chris's
of like,
voice, he's pretty passionate about that. I like how he's like, I can't tell you how many times. He probably has nightmares on how many times that's happened. So
think
I'm
about
sure he
S corp. Yeah,
knows.
S corps. Think about S corp. I just hit me like fire. Right? Fire can be really, really bad. It could be really, really dangerous. And if it goes the wrong way, you could have some unintended consequences. However, if used correctly, fire can keep people warm. Fire can help you cook and provide food for your family. So fire is not good or bad. It just has to be used the right way. Same with S corps.
Oh, that's a great way to end. So lean on your tax pro to be your fire keeper,
Yeah, be
basically.
their
So
firefighter.
and Chris, I actually heard this. I think it was just earlier this week. And I feel like I heard it way in the past too. It's a huge, and I feel it's very appropriate to what we're talking about here. A lot of people look at it and they say, "Oh, my accountant," and nothing against an accountant at all, but
Right.
an accountant really looks back in time, so they're kind
Right.
of looking in the rearview mirror. Where a tax professional, through doing tax planning, which is very very fitting to what we're talking about here.
Hmm.
They're looking through the windshield, going down the road. They're looking into the future, years to come, because
Right.
that example you gave, somebody bought a vehicle. That
Hmm.
vehicle might have been the best thing they could do at that time for their business. And then they go to sell the business and it's like, oh crap, where I'm sure they were planning for that sale a little bit, but
Right.
you kind of shoot yourself in the foot a little bit there. So it's kind of an easy way to look at it, but hopefully it's fitting.
Absolutely. Absolutely.
Well,
And one more, we said this will be the final thing. It does fall in line when it does not make sense to be an S corp. Remember, mitigating payroll taxes is the reason you'd be an S corp. I can't tell you how many times I've seen this situation. Let's say you are a professor at a university and you make $180,000 a year. You're basically filling up your entire Social Security bucket. You also then do speeches outside of it, right? You're consulting and that sort of stuff. Hey, I'm going to form an S corp. Why? You're not going to save any. You're not paying into Social Security anymore. You already maxed it out, and you actually cause yourself more tax. So you could see.
that's a great,
Yeah.
great example too.
So we're gonna step away from the mic, John. Again, this is probably as fired up as have been on this podcast. But that's all right.
Yeah, I could think of a couple other topics that we've touched on over the years, but we won't bring those up today. We'll save those for a rapid fire when, Chris, he doesn't have any hair to pull out, so I can't make that happen. But we'll have fun with that. But and also, so coming up next week on the show, we have a really good topic again with a great guest on it, and I'll give you a little preview of it. We're going to talk about farm tax. So even if you're not in that industry, if you're not in the agricultural business, the ag business, might be something interesting to listen to because it's not every day you can get this information. So we got a guest joining us on that one. And as Chris mentioned a little bit earlier too, jump on that private Facebook group, defeatingtaxes.com will actually take you straight to it. You don't have to search Facebook or anything for it. We'll put the link in the show notes for it, make it really, really easy for you. So no excuse. And be sure to subscribe to the podcast wherever you listen to it. And as always, I always feel like I tweak this a little bit, my little outro here, but we'll see you back here again next week, roughly the same time, completely different topic on the Teaching Tax Flow podcast. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.